Hi, Joe Doyle here. As a former bricklayer turned property investor, I would not be where I am today if I didn't first learn the art of business. Nowadays, a big part of my life is helping other tradesmen succeed with their business by sharing my knowledge, insights and experience. Welcome to the Tradesman Support Group podcast. I wrote a post on my Facebook page there the other day. Simple post. How can I help you today? And people are just writing different questions back in there. So one woman needed an immersion replaced. Someone else needed a wash machine replaced. Somebody asked a question which I'll read now, and then somebody wrote back by mailing me back. So they'd asked me a question and I never got back to them. Somebody looking for a house. Anyways, an interesting post, and people are just writing a bit of nonsense there as well, all in a bit of crack. Somebody says, the problem is listening to your content on the phone screen. The phone screen must be on, but it's very hard when it's in the pocket. So he wanted me to be able to allow him to listen to my content while his phone is on lock screen. And in order to do that, he needed to go and listen to the podcast. So if you're interested in listening to some longer term content, 30 minutes or so an episode there where you don't need to go near your phone, the podcast is the way to go. But we're gonna handle a question here asked by one of the guys, and I'll read it out. I would love to see you do a video. I'd love to see a video of you explaining the taxes of renting out a house. I've heard many stories of landlords getting out of the business as they don't make profit after mortgage and taxes. Also, the vetting process of how you'd go about picking tenants. Let's talk about the vetting process of tenants first, right? The ultimate way to vet a tenant, in my opinion, is just to go to the house where they are currently living and ask them how long they're living in that property and find out why they're moving out of the property, and look at the condition of the property that they're living in, and the condition of the property that they're moving out of after 3 years or 5 years or whatever the case may be. Well, you can bet your life that will be the condition of your property after they're going to be moving out with you. And it's a simple little way. The difficulty with that approach or with that strategy is that it doesn't work for people if you're taking them out of sheltered accommodation or if they're literally homeless. So that kind of falls flat on its face. What we found is sometimes, like, if you're helping people who are homeless, or, you know, like they're proper homeless, not just like, there's homeless as in they've been renting and they're between houses, and then there's homeless as in they literally have nowhere to live, they're living in a hostel. And you normally find that those guys are homeless not because of a lack of a house, although that sounds a bit crazy. They're homeless because of something else that's going on in the background. Sometimes these guys do have issues, and it's hard for you to get a handle on that. And then I've started to be a counsellor in certain instances where there's all sorts of antics going on in people's lives, and then I become part of their life because they're now living in my house, and it's all sorts of mad stuff that goes on there. So you have to be careful with the likes of that. So yeah, look at vetting the tenants is the simplest way. After that, then you really need to just use your gut instinct. Probably what went against me more times than anything else is I see a guy or a girl or a family, and I kind of more pity them. I want them to be the right person as opposed to them actually being the right person, and I'm just trying to find something going on in their personality for me to cling on, say they're good people, give them the house. And to be honest, it's not the right way, because I got myself into more hassle than anything else with bad tenants in the past. But that's the way it is. I remember one time I gave a guy a lift to look at a property, and himself and his partner, they'd been on drugs and they were just had to get their act together. And I'm like, yeah, look, I'll give them a shot at the property. In the end, he didn't want the property. I'm like, the cheeky damn fuckers, I'm not like giving him so much time that like it's perfect for him. And then 2 weeks later, the chap died. I was like, well, I'm glad he didn't die in my property. That would have been a nightmare for me, and a nightmare for me to be involved with the family and all that sort of stuff. He just kind of had a relapse back on the drugs. So, look, I spent a lot of energy and a lot of effort housing people that are homeless or at risk of being homeless. And at the same time, that's where all my grief comes from. So it's just mad, but it's just a little kind of a, would you say it's a moral compass pushing you towards that direction. So that's enough on the tenants, right? Yeah, taxes like really, really high, yeah, on rent, but it's really high everywhere as it is. Anyways, so the way I look at it is, let's just talk about income tax as the ordinary Joe soap, right? Tax is 50%. That's the way I look at it. Like if I want, if Linda wants a new car and it's 10 grand for a new car, I need to earn 20 grand profit because I pay half it in tax, and then the other half I can spend as I wish, right? And it's the same for everybody, but we've got this small tax band threshold of €33,800. So basically up to €33,800, you pay tax at 20%. And then and over that, you pay tax at 50% or 52%. I'll just call it half. I think it's even a little bit more than half. But the way it works out is on your first 100 grand, you pay about 40 grand or so in tax. And over your first 100 grand, you pay 50 grand in tax. So that's the simplest way that I look at it. And they're just round numbers. And to be honest, that's as much info as I need, because I'm just plowing on. It's half, right? People are always like, yeah, the tax is so high. It is high, but listen, it's high everywhere, right? And a big mistake I see people making when it comes to their own tax is they're trying to stay in the 20% tax bracket, which is crazy, because nobody ever got rich on 33,800 quid a year. It's just it's numerically impossible to get rich on those numbers. So I always encourage people, get out there into the higher tax bracket as quick as you can. If you're earning 33 grand, right, and you're on the 20% tax, and then you've got a property that you've got rented and you're getting £1,000 a month for that, well then that's deemed as another 1,000 quid a month. That's deemed as another 12 grand on top of your income. So you're now not earning 33 grand, you're now earning 45 grand in the eyes of the revenue. The difficulty you have is there may be no money left of the rental property where you collect 1,000 quid a month. Makes sense? So there'll be no money left, but yet you're pushed into the higher tax bracket, which means you need to top it up even more. And that's what I think throws a lot of people off. We've got these PRSI, USC, all these different scams that the government add on to get more money out of us. I don't believe we get anything back from them, but they keep telling us we do, But I think that's the big thing that catches people out, is that they're getting 1,000 quid a month in rent and they're paying 1,000 quid on the mortgage, but yet their tax has gone up because now they're deemed to be in the higher tax rate, So you need to be careful on that. The other thing where I see people getting caught out on with the tax is that they believe that because they take in 1,000 quid a month and they're only paying out 1,000 quid a month, they have no tax liability, they're break even. The problem is that it's not the case, because some of the bills that they pay out of that €1,000 a month is actually non-tax deductible, right? And I've just got a couple of little notes here, right? So if I just done an example, purchase price 200 grand, rent 2 grand a month, what would you be paying on that? Roughly, you'd be paying a mortgage of 900 quid. You'd be paying property tax of around 350 quid. You'd be paying maintenance of around 250 quid a month. And then we have some more taxes, and I'll talk to you about that. I'll talk to you about the taxes in its entirety now in a minute. Maintenance, you might be saying, I wouldn't pay 250 quid a month. Should I go months before the tenant ever rings me? Of course you go months before the tenant rings you. But then you have a gas boiler, that's 2 grand to get replaced, thereabouts. You'll have a bit of maintenance on the roof that need to be done every couple of years. You've got these bills that come in every now and then, and they clatter you over, yeah. So you need to throw a certain amount aside. I think at the minute we're putting 350 per property per month aside, and that just keep. We actually broke our maintenance down to maintenance, and then last year we set up an account called a 2020 account, which was stuff we kind of predicted. Like if you've got 10 properties and a gas boiler lasts 10 years, well, chances are that works out to one boiler will need to be replaced every year. You might get 1 year where you don't need it, and then the next year you have to do 2, or you might get clattered over with 3. you need to set the money aside, you know. So we're setting aside currently in the office 350 quid a month per property, but at the same time that's covering some of the property manager's wages and a few other overheads as well, where you wouldn't need to set aside that much if you had just 2 or 3 properties. I'll talk to you just about where the kind of the hidden tax comes in here, right? When you pay your property tax, which is 350 quid a year, which is not a big amount of money, right? But the problem is it's not tax deductible. So what that means is, let's just say you're left with a profit of 350 quid. And then you have to pay, let's say just for the whole year, the only profit you've made is 350 quid. And now you get your property tax bill in, which, surprise, surprise, is 350 quid. In your eyes, you'd be like, yeah, well, I'll just pay that out of profit, and then I've made no profit and everything's covered for the year. That's not the case. The reason being, the property tax is not an allowable expense. So you've got 350 quid of a profit. You pay that profit towards the property tax. Because that 350 is not an allowable expense, the revenue will say, hey, you've still made a 350 quid profit there. We want half of that. So you're now in a situation where you've actually got zero money in your bank. You've got zero profits on that property, but you still need to pay tax on the 350, which was the notional profit. On the actual LPT, the local property tax, it's a payment that goes out once a year. It's not really the end of the world if you manage it correctly. Like we got hit with our bill there the other day. They deferred the property tax from being collected up until in the last couple of days, and we had to actually just this week we had to pay it. So we paid our property tax. It was a few grand, good few grand. But that's not an allowable expense, which is a bit of a kicker, you know. Outside of that, the next thing that you need to look at is the mortgage, right? So the way it works is when you borrow money off a bank, they give you 200 grand as we used here for the example. Well, you don't just pay 200 grand back to them. The 200 grand is the amount that they've loaned you. That's called the principal amount, or sometimes it's called a capital amount. I actually call it a capital. It's called a capital amount. And then they charge you interest. And a 200 grand mortgage, you'd be actually shocked if you heard it, when you hear this, if you don't know, but a 200 grand mortgage over 25 years, you'd probably pay it back about 320, 330 grand. I could run the numbers there now and let you know exactly what it is. But you pay a colossal amount of interest over the lifetime of the mortgage, right? Now, every month, it's not as if they take back all the 200 grand that they've loaned you, which is the capital. So it's not as if they take back the capital first and then they charge you the interest. Every month they charge you a little bit of capital and a little bit of interest. Now, the interest that you pay to the bank, that is, at the moment, that's allowed as 100% tax deductible. Simple, easy, boom, right? You paid 500 quid interest, you get an expense, it's an allowable expense of 500 quid, and that's the end of it, right? The capital that you pay back, so in this instance here, I'm saying that you're paying back a repayment of 900 quid a month, right? In that 900 quid, you're probably paying back 650 interest and 250 capital, right? Which means every time you pay 900 quid back to the bank, your mortgage balance comes down by 250, which is a bit demoralising in itself when you see how hard you have to work to pay your mortgage and it only comes down by a little bit. The 650, allowable as an expense, no problem, easy peasy. The 250 is not an allowable expense. So like what I was using as the example with the local property tax there, they view that as profit, which means you have to pay the tax on that again. So if I was paying capital of 250 quid, well, that's 250 quid from an after-tax amount, so I need to pay the same 250 again. So what you actually do is when you're adding up your monthly outgoings, your mortgage, your maintenance, you have to actually add in an amount for the tax on the capital of your mortgage, if that makes sense, you know. So the way we work it is just to keep it loose numbers. Whatever you pay in capital, you need to set aside the same amount again. Now, I've been shouting about this stuff for people for years, and then they go off and they do deals, and then they come back and they're like, oh, I'm not making any money on the deal. I'm like, yeah, no, you're not. I could see, like, within literally 30 seconds of you presenting the numbers that you weren't going to make any money on the deal. The way I've got two rules of thumb, yeah. Always aim for 1% per month. So whatever you buy a property for, make sure you get 1% of that value back in rent every month. So that means if you pay 200 grand, you must get 2 grand a month. If you pay 150 grand, you must get at least 1,500 a month. And if you pay 100 grand, you must get a grand a month. If you don't aim for those numbers, you're goosed, right? You're going to get caught out there later on. And then people will be like, oh yeah, well that's different for you up in Dublin, that's different for... Listen, it's not different, because the rent is more expensive in Dublin, but the houses are a hell of a lot more expensive as well, right? So the real thing you need to be careful of here is your yield. So you're looking for a 12% yield, which equates to 1% rental income every month based on the purchase price. Simple as that. So when I'm looking at a deal, I'm like, is that 12%? If it's not 12%, I ain't going near it. And will I go after a deal if it's not 12%? Yeah, I will, yeah. But that's the benchmark. But there has to be a bit of justification as to why I would go after a property. So you might be buying something with a bit of a site on it, or there might be a bit of an upside of some sort. Whatever the case may be, you go out and you have a look at it. But that's the benchmark, 12%, you know. Another simple way of looking at it is if whatever you pay on your mortgage, if you add 50% to that. So if your mortgage is £1,000, if you add 50% to that, which is 1,500 quid, now this is very crude, right? But it works bang on, right? Which is mad, right? So if your 1,000 quid a month is your mortgage or payment, add 50% to that, which is another 500, it's 1,500 quid. That's your break-even point per month, and that allows you a little bit for your maintenance as well. Simple as that. So whatever the mortgage is, stick 50% on it. So if your mortgage is £2,000, you need to stick 50% on top of that again, which is another 1,000. So now you're at £3,000. And anything over and above the £3,000 that you get will cover your expenses on the property. If it's 800 quid, add another 400 onto it, and then adding over the 1,200 quid you get is disposable income from that property. It's hard enough to make the numbers work, to be honest, in a lot of instances. And look, I do a bit of business coaching. Well, I do a good bit of business coaching. That's one of my main businesses these days. But I do a little bit of business, or do a little bit of property training. I've got a small group of people, about 30 clients there, right? The problem for most guys is they can't find the deals and they can't make it work, and they're lacking just a few little things to get their deals over the line. And I'm pushing them all the time, 1% a month or don't go near it, 1% a month or don't go near it. And then sometimes people get agitated or they get pissed off because I'm telling them not to do certain deals. And then they might go and do a deal, and the problem is a curveball comes in and you're left tight then, you know. That's really what it is, you know. We're ramping up there. You might have heard me talking about Joe's Investment Bank. So we are caught between two, the Bank of Joe and Joe's Investment Bank. So we're ramping up now, and we're actually getting better at what we do, in that we're not doing any bigger deals, but we're just doing the same deals and more of them. So I don't know what our deal number is at now, this part, and we're just beyond halfway through the year, but we're definitely on 7 or 8 deals for the year, which is good. So we're doing one a month now, which is good, and we want to keep going. But my plan now over the next one, because there's so many people approaching me looking for me to help them with their property investing, and I'm happy to help them, there's no problem. The difficulty is most of them don't really get the results, you know. So we're looking at putting a package together where someone comes in, look, Joe, I want to do a deal. Right, listen, I'll do the deal for you. You can bring something to the table. You can bring a bit of cash. You can bring a mortgage. You can bring something. So we're looking to do it by way of more of a joint venture, because a lot of the lads are losing heart and they're getting demotivated before they get the first deal over the line. So we're always looking at ways where we can improve our business. We can be of more value to our clients as well. And it's all good stuff, you know. Like, at the end of the day, people are always going to need somewhere to live. They're always going to need somewhere to live. Taxes get brought in, this and that, and you do need to be careful. And there's a lot of landlords exiting the market all the time. I'm a little bit different, so it probably sounds a little bit hypocritical. Like, we're going at and we're doing more and more. Look, I'm 36 years of age, so I can do this for another 30 years, right? I've got plenty of juice in the tank here, right? The problem is when guys get a little bit older and the legislation gets more stringent and tenants start wrecking their heads and they're like, you know what, I'm just getting out of it, right? That's really what it is. The market has changed so much that a lot of the guys are now disincentivized to be in there. Where I'm like, look, I'm going to plough in, you know, I'm going to just plough on. I'm going to do as many deals as I can. I'm going to get closer to completing my mission and keep going at it. The challenge or the difficulty at the minute is we've got an interesting scenario going on there. The Residential Tenancies Act is the the law that governs the relationship between tenants and landlords and all that, and that's enforced by the RTB. There's a crazy, now maybe I'm just paying attention to the wrong thing, or I'm paying attention I'm paying attention to it too much, but I don't particularly have much faith in the RTB. They seem to be very pro-tenant all the time, and if a tenant gets awarded damages against the landlord, the tenant does get the money. If the landlord gets awarded damages against the tenant does a burner and you've no chance of getting the money. So I'm very sceptical of how they operate in the RTB. However, I'm looking at these tenant activists and they're also sceptical of the RTB. So it's like nobody trusts the governing body there, which is absolutely crazy, you know. So there's a lot of animosity in the marketplace there at the minute between, I suppose it's at a high level. There's no animosity with us in our, like, we've got an amazing group of tenants and we get on really, really well. We had a lot of problem tenants at one stage, and tenants with problems, and they cause more problems for us. But luckily enough now we've got a really good group of tenants. The problem going forward in the marketplace is, I believe it's turning into a kick the landlord economy, right? Taxing for this, taxing for that. At the minute now, there's legislation coming out that says you can't be put out of your house until January, even if you're not paying rent, right? Now, I know a couple of landlords where the tenants are simply paying them nothing, and the landlords are expected to make the mortgage repayments, right? And these guys are going to end up losing our property or their property or a couple of properties, but the law is now against them, you know. So I just think that we're going to be going into a situation where the kick the landlord economy is going to get more strict, right? There's going to be more landlords leave, and the housing crisis is going to actually get worse. Well, I don't even call it a housing crisis. I'd call it a rental crisis, because I don't believe there's an actual shortage of houses in Ireland. I believe there's a shortage of rental accommodation at an affordable level in certain parts of the country. As soon as you move out of the country and out of the cities, there's plenty of stock available. But people don't want that. They want to be in the city, you know. So I think over the next maybe 3 years, I think things are going to get a lot tougher for landlords. That's being very, very honest, you know. And when it gets tougher for landlords, to be no investment, to be no landlords coming in. And what's going to happen then on the back of that, in my opinion, is it's going to be a bigger squeeze on the rental sector, right? Because the supply will go down. Because bear in mind, anytime a house gets sold, that's a rental house, it gets sold to a homeowner, right? Because there's no more landlords coming in. And I think it's going to get worse, and it's going to be a bigger squeeze. And the political appetite is there at the minute to kick the bejesus out of the landlords. And I think one day someone's going to turn around and say, listen, we're going to need to do something for these landlords. They're going to turn around, they're going to incentivise us back into the market. And then when they incentivise us back into the market, the landlords are going to be seen as the people who's now buying the houses to make them available to people on that app, or just rent them out. Because at the minute, like, it's crazy. If you're a landlord and you accept HAP, you're seen as an enemy of the state. You know, you're called a parasite. I'm like, hold on a minute. I'm buying a house and I'm giving it to the government to rent it to someone else. And the person that's living there, they're effectively getting the house for free. But but I'm renting it. I'm buying it and I'm collecting rent from the government. And now, you know, it's a mad vibe out there at the minute, you know. So what will happen is that will get worse, and then it will get better. And I think a little bit of equilibrium will come into the market then at that stage. I hope it does, to be honest, because I've seen the attitude change towards landlords over the last little while. And it's crazy. It's crazy. You know, it's mad stuff. Look, I get me fair bit of grief over from time to time, but maybe I deserve all that. I put my neck out there to be. I've raised my head up to for people to take shots at it, you know. But look, at the end of the day, once you're doing the right thing, and the right thing, in my opinion, is providing good quality accommodation to people who deserve it and respect it and treat it well, overall we'll be doing okay. What I would say to people is, if you're considering getting into property, buying one house is probably not the best idea in the world. If you're getting in, try and make a plan to get in and buy 5 houses. But you don't buy 5 houses at once. You buy 5 houses over a period of time. And the reason for that is, if you've got one tenant and that one guy doesn't pay you rent, well then 100% of your tenants are not paying their rent. Whereas if you've got 5 properties and one guy doesn't pay his rent, well, now you've only got 20% of your rent not getting collected, and at least you have other money coming in. So, like, the bigger you get, the easier it gets, if that makes sense. So, for example, in our office there, we're managing a good few properties now. There's always arrears payments coming in. So we probably have, say, 5 grand's worth of uncollected rent every month. Now, you collect it the following month, and there might be some reason why somebody got disconnected off the social, or there's always something, right? If you only had one property and your tenant was in that kind of group, you'd be snookered, where we can just shoulder it and we know we'll catch up on it the next day. And also, our maintenance cost is very high per property at the minute, but within that maintenance cost, we've got a property manager. So his wages are basically getting paid out of the maintenance money, right? Now, what that will do for us is, whilst it's more expensive at the minute, it means I personally don't need to respond to any of the damages or any of the breakages or the maintenance that happens in any of the properties. And we could probably double our portfolio based on that one property manager being there. So after we get over this initial hump, our maintenance costs will be cheaper per property than somebody who has 2 or 3 properties then, you know. So at the minute we're paying more. But, you know, it's like, as your business grows, you need to put a layer of management. So you've got those doing the work, and then you've got those watching those who are doing the work. So if you're a landlord and you're just starting off, you'll be just doing the work. Whereas as your portfolio grows, then you'll be watching those who are doing the work, and that just adds in another layer of cost there, you know. So, look, that's the story, guys. Just simple rule of thumb, aim for 1% per month and outside. And if anybody wants any help with that, feel free to give me a shout. You can catch me on info@joedoyle.ie. You can send me a message on my Facebook page. I'm fairly contactable. I'm on Facebook, I'm on Twitter, I'm on Instagram, I'm on TikTok, and I'm at info@joedoyle.ie. So you can catch me anywhere. I do believe that everybody should go out and make a go of it, you know, and at least go and learn. You know, learn, do something. I think everybody should have 4 rental properties plus their own home paid for in full. I think that's what they should do, and that gives a good base of wealth for future generations to add to then, you know. So guys, listen, I will leave that with you. Thank you very much for listening, for watching, and I'll see you at the top. So guys, thank you very much for listening in today. If you're struggling with any aspect of your business, do not suffer in silence. All good business owners learn from the mistakes of others, and trust me, I've made a lot of mistakes before getting to where I am today. You can ask me any questions you have by reaching out to me and messaging me on Facebook by searching for the Tradesman Support Group by Joe Doyle. Thanks for listening, and I'll see you next time.